Hey everybody, it's me, the Einstein of Wall Street, here from the balcony at the New York Stock Exchange. We are in the beginning of September. This is a absolute breaking news, pivotal time. This market is absolutely, in 2025, this market has seen absolutely everything that a market can see. We've had the high highs, the low lows. We've had massive sell-offs. We've had incredible rebounds, right? We've had everything except what is about to happen on Wednesday with the Federal Reserve. The one thing we haven't had happen this year yet is an interest rate cut. We are about to embark, courtesy of words that I heard from my man Tim Anderson last week, is we're about to enter a interest rate cutting cycle. Why not? Better to hear about it from the man, the myth, the legend, my man Tim Anderson. Welcome.
Peter, thank you so much. It's always
pleasure.
a pleasure to speak with you.
My pleasure. So look, we're in September. If you think about 2024, once again, a year that saw absolutely everything, right? We saw 7 spectacular pullbacks, one in April, one in July, one in August with the massive crash that we had versus the Japanese stock market. Then finally in September of last year, we did finally, all very well anticipated interest rate cut. It was at 50. Right? We felt like we had we felt that the Fed probably missed an opportunity in July, and they came in at 50 basis points in September. Market had sort of a mixed reaction, net though. The first reaction was down, and then it followed through on the upside. And then we ended up seeing 225s to follow, a 100 basis point cut in 2024. We ended the year up solid, double digits, right? More than 20% on the rise in the S&P 500. We're now in 2025. We know in 24 we had 218 trading days, 58 record high closes across the board from Russell, S&P, Dow, and NASDAQ. Once again here, day after day, week after week, we are hitting record after record, even though this has been a completely different kind of a year. We have a new administration that's major. We know that we had a massive 20.8% sell-off February, March, April due to the self-inflicted, and we're going to have some dissent amongst the ranks here on this one because we see things from different sides of the table, but a self-inflicted economic Armageddon based on the way that dissemination of information was based on tariffs. Now we're starting to see the impact on tariffs, on the economy, on the consumer, on companies, on the markets, on employment, and all that kind of stuff. The Federal Reserve Chairman has held his ground against the better judgment or the decision-making by the new sheriff in town about cutting rates up until this point. He held his ground. He did not feel that the economic data, his decision is an economic data-based decision. He did not feel, that's J. Powell, did not feel it was necessary or the components were not in line to cut rates yet. His fear was stagflation, right? High inflation, low GDP, and low growth and high unemployment. So, however, at the August meeting, on that Wednesday, this past August meeting, the last Fed meeting, we got nothing from him. We did not get guidance on what was going to happen in September. We did not get a cut, which everybody felt was due and ready for action. However, what we didn't get on Wednesday was unbelievable because literally Thursday, Friday, boom, out of the gate, Friday was the beginning of an absolute windfall that has continued till today of economic data that has showed the softening of the economy, the levels and the impact on tariffs on the employment sector, 4.1, 4.2, 4.3 unemployment going up. We're seeing what it's affected in GDP. We're seeing the effect of tariffs on the globe, on corporations, listed ones, all of that. And so what we saw happen in Jackson Hole was a massive pivot by Jay Powell. Whether you like him or not, it was a massive pivot where he felt that the economic data finally was ready for interest rate cuts, and he set the stage for what is going to happen on this Wednesday. So I just wanted to get Tim's tack because he's just brighter than heck, and he's got the wonderful big global look at what's going on. The whole spiel I just gave you, what's your tack on all that? It's a big mouthful, but go for it.
So my take on that is that Powell is really being forced to lower rates because it's very clear now that the employment picture has weakened and there is a number of data points.
But he's being forced by the economic data, not by the president.
Correct.
Okay, go ahead.
And that a number of data points have come out, including just last week's
CPI
employment.
Right.
Their weekly jobs gains showed weekly employment claims were up 265,000.
Biggest in like many years.
That's a high number.
Right.
And also, I think what was really the tipping point was this once a year revision showing that from August 24 to August 25, we gained 900,000 fewer jobs than what all of the data had reported, which meant that our average annual job gains were about 75,000 a month rather than 150,000 a month. That's not even enough to keep up with just the normal birth rate and attrition in the economy. And that certainly reinforces the viewpoint that there is just a major procedural problem at the Bureau of Labor Statistics with the way they accumulate data. I mean, this is 2025, and they still have methodology from like 50 years ago that have not adapted at all, and they've had a very sharp sell-off in the amount in the surveys being returned to them.
So I heard actually that the survey is actually sent out to only 600 people. That's crazy.
Look, the surveys are sent out to whoever they're sent out to. I think it might be more than that, but I don't have those numbers in front of me. But those are surveys done for the third full week of the month. Because people want August data at the beginning of September, just to name a couple of months. So, but what's been happening is the amount of people that have been returning those surveys has declined by about 50%. So that increases the potential error rate for when the real hard data
100%.
comes in, and why a lot more people have been looking at ADP. ADP, because of who they are, they process payrolls. They have hard data right out of the chute. The Bureau of Labor Statistics starts with surveys, and then when
this is 2025,
and then when data starts to come in, they get revised and revised. Well, 2 years in a row now we've had this annual revision that takes away 800,000 jobs from August 23 to August 24, and then we had 900,000 jobs taken away from August 24 to August 25. So, to make a long story short, there are signs of concern about the job market weakening, and because inflation, even though it hasn't gotten all the way down to 2%, I've always viewed that 2% to be a mythical number. That it's not
came pretty close from 8.5.
It's not going up. It's the producer price number was
a little weaker.
Was much lower than anticipated. We came in at negative 0.1. where the expectations were for positive 0.3. And that was following a month where we did have a little bit of a tariff impact. In the previous month was initially plus 0.9, almost 1%, but that was revised lower to plus 0.7. So a lot of people feel, okay, we got that one-time tariff effect a month ago, and now it's cooled off. So then the CPI came out, very much in line with what people were expecting, plus 0.3.
Consumer price index, production price index.
So the PPI is more of a wholesale number at the industrial manufacturing level, rather than the consumer price index is what you and I are going to pay at the grocery store, the gas station,
and the impact of tariffs is going to show some of these companies are absorbing.
A lot of companies have said very, very out front. They've been very upfront about it. Look, we're eating a little bit of this, but we've also got our suppliers to eat some of it. We're passing a little bit along to consumers, but so far it has not been anywhere near what the doomsdayers were talking about when we had this tariff tantrum in April that went on into maybe early
which
May.
I called the mini crash. Go ahead.
So now where are we? The Fed is inevitably going to cut rates at the Wednesday meeting.
90% possibility of 25. What do you think about 50?
I think 50 should be on the table.
I do too.
Okay.
Rip the Band-Aid.
It's most likely going to be 25. And then they'll most likely, the Fed Fund futures contracts are also projecting another 25 basis point cut in October or November. It's actually very, very late October, the last couple days of October. And then a 25 basis point cut in December. So that would be 75 basis points. Just as a frame of reference, in that 3-meeting stretch last year, we had a 100 basis point cut.
50, 25, 25.
So now I think the important thing will be what the language is coming out of that.
Sit on your hands at 2 o'clock and wait for the press conference, because that's going to be pivotal to watch what the market does. People are going to be hanging on every word that Jay Powell says.
Right. And also, investors are always very concerned about a potential market swoon, if you want to call it that, in September.
Right.
That and
You mean
this
historically
September,
that
early
markets pull
October,
back
the
September,
market
October.
has had some very weak moments
Going
in
back
the
to the
past.
crash of October, Black Monday, right? Which
It's
we were
going
here
back,
for.
going back to 87,
Yep.
right? So, but it's seasonably a very vulnerable time for the market. I think the reason we're not having that this year
Tell me.
is because, well, right now we're the middle of September. We're 2 weeks from the end of the quarter.
we're trading at
It
record
would
highs.
certainly not be in investors' interest to beat on the market hard going into the last 2 weeks of the third quarter, because there are some hedge fund managers out there that rely on quarterly performance.
Right, and there's also a lot of underinvestment in the market too. People are playing catch up.
That's the key.
That's the key. Okay,
Because
tell me what you think.
a lot of hedge funds and a lot of institutional money managers got caught after the big April sell-off.
They were selling when retail was buying.
Under invested.
Yes.
And they had
He's validating what I'm talking about.
underperformance in the first half of the year because of that April
Sell-off.
big
Yep,
sell-off.
yep. And then the bounce back.
They can't afford to be underinvested
At the
now
end of the third
if
quarter.
we continue to rally
higher.
into the
Yes,
end of
thank
the
you.
year.
Yeah.
So look, the market is certainly not cheap, but we're talking about 23, 24 times earnings on a forward
on an S&P
basis.
forward look, right?
The people that are buying the market now are justifying that by saying the market
Today's
is
highs are
going
tomorrow's
to,
lows.
The market's going to grow into those.
Talk to me about
earnings.
that. You said that to me last
So
week.
if
the companies are growing into their
earnings, if earnings go up significantly over the next few quarters,
Right.
and there are some reasons why earnings will get a natural boost. Okay. Then you'll have maybe what's now a 24 PE on future earnings projections. Those earnings projections will have to go higher. Maybe that'll go down to 22.
Okay.
Maybe it'll go down to 21. Now that's still not cheap.
Right.
But with all of the tax implications from this big bill that was passed earlier, and from companies being allowed to immediately expense capex expenditures,
Right.
that's going to improve their cash flow and improve their earnings significantly for fiscal year 25, and even for 24 if some of them are on an off-calendar cycle.
Right.
Okay. So so that will help companies' earnings projections.
So
and
explain
also,
that. So good. Sorry to interrupt you, but go over that for everybody. So explain that, because that's the big bill, right?
That's the
and
big
you
bill.
believe it's a good bill.
Yes.
Okay. And so explain to me the tax implications of the big bill.
So that
people
look,
understand.
I am not a tax accountant or a tax attorney.
Correct.
But I will say that one of the most underreported implications of this bill is the fact that companies can immediately expense capital expenditures.
Okay.
Read anything to do with AI, plant, equipment,
which is big now. You're talking massively. You're talking Microsoft, Google, Meta are putting $600 billion into CapEx, as well as obviously NVIDIA and the rest of the Mag 7s.
Right.
So now they're going to be able to, as opposed to amortizing it, they can expense it now.
Yes. And they can
deduct it.
And they can go back to last.
So that's
and
going to boost earnings.
I just read over the weekend that they can do that for 2024 also.
Wow.
Okay. And so typically you would amortize that over a 5-year period or over a 10-year period.
Right.
So they have to shell out and
putting
up
a bunch of money and not be able to deduct it. So it comes as an expense, as now it's offsetting.
If you go back 40 years ago when Reagan, there were 2 big tax bills in the Reagan administration. The second one included accelerated depreciation. Okay, this is that on steroids, because this is not just accelerated depreciation, meaning
it's immediate.
Taking the time frame from, let's say, just hypothetically 10 years to 5 years,
right,
and being able to expense more of it in your current year.
Right.
This is immediate
and total.
Expensing.
You can expense it all immediately, take it off the books, with no tax implication there.
Well, it's going to be it's going to reduce your your income and then your taxes.
So that should boost. So that if you're looking at forward looking, it's going to boost cash, but it's also going to boost earnings.
Yes. Yes.
Wow.
Yes.
Oh, that's extraordinary. It's huge from the corporate point of view.
Yes,
Less personal, but
yes,
corporate.
from the corporate point of view, that
At
will
the
allow
same
them.
time,
that will allow them to build more plant, hire more
data
people,
centers, hiring,
and
all of that.
boost. That will be an additional boost to the economy. That's not going to happen overnight. It's not going to happen next month.
Right.
But like we talked about weeks and weeks ago about how, look, some of these plants won't come online for 2 years,
or more.
But they have to be built.
Correct.
And that
Again, but
employs
you know,
a lot
I
of
love
people.
that about you because, you know, look, there are people who are complaining, and I was one of them, who said, you know what, the president keeps saying about, you know, build America and it's going to be this and that. And but it's 5 years out. How is that going to impact us now? But what Tim always talks about is he's thinking smart. Is that think about it? The minute we break ground on these data centers that may not be completed and in production in 5 years, they still have to be started. They have to be built now, and that starts with employment. That starts with manufacturing. That starts with productivity. It starts with everything.
That's more demand for earth-moving equipment. That's more demand for
absolutely
putting in
everything.
electric lines,
Exactly.
sewer lines,
right?
You know, plumbing.
Going to the diner and eating lunch. The workers. It's all there.
Yes, more food carts.
Yeah,
more,
everything.
More.
Absolutely everything. So you're talking about
Think about building a house like times a million.
Exactly.
Okay.
Building exactly.
So if you're building a house, there's subcontractors involved.
Yep.
There's people that come in and paint. There's people that do drywall. There's people
there are people who go to lunch and go to restaurants. All of it.
Right.
I never thought of that when somebody and I were talking about real estate the other day, and that because of the higher interest rates for longer, that the real estate, maybe it was you and me who were talking about, is completely frozen.
Yes.
And that lowering interest rates now and a cutting interest rate cycle is going to jumpstart the real estate industry. And what does that mean?
And that's a great point, because look, there are some sectors of the market that don't necessarily need lower interest rates. They would like lower interest rates, but they're doing okay as it is because they're growing faster than the current rate of inflation.
Right, correct.
And they're growing faster than what their current the interest due on their bonds. And look, frankly, a lot of tech companies don't have a lot of debt outstanding anyway.
Right.
But there are some sectors of the economy that have
suffered from higher interest rates.
Suffered because rates. You've got millions of people that are in 3.5%, 4.5% mortgages that would like to sell their house, but they don't want to trade into a 7.5% mortgage.
Correct.
So, to that degree, the housing market has been on lockdown a little bit because of that.
Yes.
Now, there are some lenders, I am told, that a friend of mine, I was just having a conversation with him late last week, said a bank that he's done mortgages with a number of times in the past is calling up, offering him rates like much lower than other people.
Right.
I think they're just getting ahead of these rate cuts. And that will help loosen up the housing market. I also think that there will very likely be some special incentives for building more. We need more single-family houses.
Yes.
And there will be some type of a program that comes out before the end of the year or early next year to incentivize that and maybe take away some of the
barriers to entry or the difficulty.
Some of the regulation in some areas, although a lot of it's local.
Right.
that has been just incurring a prohibitive cost on a lot of it.
So we just broke down that big bill, which obviously that's huge. That is absolutely pivotal on setting the stage for what the next 5 years are going to look like as far as growth goes, as far as tax implications, as far as the corporations that are up against the gun, because the bottom line is, yes, tariffs may not be 185, 145, 75%, but they are not 10 and 15% either. And so we're starting to see the implications on the consumer, on retail, look, we saw consumer confidence go way down recently. That was not a particularly good thing. We're starting to see the expenses of whether it's on the shelf or your kid having to spend $25 for a knapsack and let's go back to school phase that happened. We're in September now. Let's remember where we are, right? And then, and what are the shelves are going to look like going into the holiday season and all that kind of stuff. The impacts of tariffs are substantial. However, it's important. If we were to talk, and we did talk, if we go back,
around.
What's that?
It's being spread around.
It is being spread around. Some companies are absorbing it. Some manufacturers are absorbing it. Some people are passing it on. We know that Amazon's last earnings report, which was solid, the stock went down as a knee-jerk reaction because they said that they are absorbing a big part of the tariff expense and not passing it on to the consumer. But then we saw Target and Walmart say that we cannot absorb all of that cost, and they're passing a lot of it on to the consumer. These are the things that go into this. These are the components that make up this amazing puzzle called the economy that Jay Powell is going to have to consider when he does his cut rates and all that. But what we're setting the stage here for is, look, this is an extraordinary year, and we know, look, let's think back to here for a minute, that what was I going to say as far as tariffs go? Yes. When we go back to when we talked in February, March, and April, and the market was in that down bow of that horrendous April 19th low, down 20.8%. And we talked about, and I was talking with Dan on CNN, we were talking about what is it going to take to keep us from a complete interruption of the supply chain, going back to the COVID days. What is it going to take when you've got Lutnick and Besson talking about deal, done, but they weren't happening? Right, we were in that weird we were in the corridor. We weren't on the side. We weren't there. We couldn't see the light at the end of the tunnel. We were in that economic Armageddon feeling. Because I know when I was in it in February, April, March, I did not know. I kept saying, are we going to look back at this time as a time we should have sold because it's going to get worse? Or is this once again a buying opportunity? It turned out I was wrong, and I've mea culpa through the kazoo here because I was wrong. I could not put myself in Mr. Trump's head to figure out what his plan was, but he must have had a plan, and now that plan is being bore out. Because as of this morning, we're seeing 50-50 deals with Japan, UK, EU, India on the horizon, almost a deal with China done. So the checklist of all the things that Mr. Trump needed to get done to get this market and the economy jump-started and going. That's why he was pressuring Powell, but Powell had to hold his ground based on that fear of stagflation shtick. But at the end of the day, we are here in September. We know we're getting cuts. The key now is all eyes are going to be on the Fed because now we got to see if it's 25 or 50. And then once again, the real wild card is how is the market going to respond to either one?
That will be.
Is that 25 baked in or priced in? I hate that priced in shit. It doesn't make sense to me. What does that mean? That means that the market's rallied in anticipation of, or is 50 going to be a good thing? Rip the Band-Aid, let's boost up, pour gas on the fire and whatnot. Or are people going to go, wait a minute, if he's doing 50, that must mean we are in worse economic condition than we think, and that maybe it's time for this market to have a pullback. And that's a possibility.
Of course it's a possibility.
Yeah,
We've had a very, very strong run. And, a lot of people would say a little bit of a pullback would be healthy.
Correct. And it seems like it would.
You would be talking more, maybe 2 to 3%.
Yeah, because once again, what we just said to you is, every little bit of a pullback that we've had all these months, right, is being rebuffed by the fact that those who are underinvested can't afford to let the market pull back 5 to 7% to buy things cheaper. It's not like, at Christmas.
Can't afford to miss.
Exactly. So it's like not waiting for the 50% sale at Christmas. They're waiting for it to go down just a little. They can't afford.
They had underperformance in the first 6 months of the year. They can't have it in the second half.
Exactly. And coming into the end of the third quarter, fourth quarter historically, once that happens, is off to the races. We've seen, think about it, 2020, even in the eyes of COVID, up 20%, 21, 22% up. Obviously, 22 was a function of the 18 times that the interest rates were rose and all that kind of crazy stuff. But 23 and 24 up 23.8% respectively. We're up 100% since COVID. Okay. I attribute it a lot to the way that Mr. Powell navigated. I'm a fan of the guy. Whatever anybody thinks, he got us to this point, right? Economically and market-wise. And either way, we're not in bad shape economically, and market-wise, we couldn't be higher.
Right.
That's kind of where we are.
Yeah.
So you know what? Look, I think, we can't predict what's going to happen on Wednesday.
Right.
It is a bit of a wild card. All eyes are on it. I know the investment community is sitting there on pins and needles, sitting on their hands, waiting for what's going to happen. There's no point in us even predicting it. But it's not only going to affect the fourth quarter, it's going to affect what happens in 2026.
Sure.
And all eyes are going to be listening to his posture, because if you'll remember this, I have a crazy bit of a photographic memory. Last year, we were on this absolute spectacular trajectory into the end of the year until the Federal Reserve, the last meeting of 2024, Jay Powell came on. We were looking at 4 interest rate cuts for 25 and 26.
Yeah.
And he came on and said, you know what, because the economy is doing so well, I'm cutting back guidance down to 2.
Right.
And the market responded with a 1,000-point sell-off.
Yeah.
Remember that?
Yes.
Yeah. And that kind of dislocated that rally that everyone was hoping we would end the year at the high. We didn't. We weren't far off it, but we definitely hit a pullback.
Right.
So you know what? That's all that's possible. We've laid out to you absolutely a spectacular breakdown on what 25 looks like. All eyes are on what's happening at on Wednesday, so just keep an eye on that. And that's all I got to say. You are the man. We've given you so much information about what's happening in this market, what's happening in this economy. If you are investing or you are trading in this market, look, the lifeblood of the markets are earnings and guidance, and we've gotten that. Last quarter, we didn't get any guidance because of the unknowns about tariffs. Now we have all that. Now we have all what's going on with the Federal Reserve starting this interest rate cycle on the cutting side. Markets are forward looking. It looks good. Look, a pullback would be healthy, and maybe that's what we're going to see. But you know what? You got to be in it to win it. That's all I got to say about that.